Welcome back to Miller Momentum. Today we're going to talk about value investing at a global scale and one of my favorite investment firms, Avantis Investors by American Century Investments. But before we get started, a quick disclaimer. I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. Not only are we going to take a look at Avantis Investors' general strategy today, but we're going to focus specifically on AVGV, which is an ETF that implements their global value portfolio tilt. And after going through that and breaking down the detailed specifics of that fund, we're going to go behind the scenes and run an extensive backtest and... Wait, what? What happened to the color of my shirt? Uh-oh. I think I went a little too far behind the scenes. Where did AVGV go? What was that? I heard something. Oh, whew! It's AVGV. Well, we're back and ready to do the deep dive. I'm going to walk through a full evidence-based explanation of one specific fund, the one I've already mentioned, AVGV, the Avantis All Equity Markets Value ETF, or as a lot of people call it, the Avantis Global Value ETF, although that's not its official name. If you've ever heard people talk about tilting toward value or factor investing and weren't quite sure what that actually means, well, this video is for you. I'm going to build the whole idea up from the ground, from scratch, with no jargon left unexplained. We'll cover what the value factor is, the academic and popular research behind it, the honest recent case against it that some people make, the story of the firm that's become famous for this approach, and exactly how AVGV is put together. And here's the twist. AVGV is a brand new fund. So at the end of the slide deck, I'm not just going to wrap things up. I'm going to set up a backtest where we recreate this fund's basic strategy using decades-old data so that we can actually see how a strategy like this behaves over the long run. Well, let's get into it. Here's the roadmap for today. First, the foundation. What value even means in the context of stocks, and why anyone thinks cheap stocks should behave differently. Then the evidence, the academic research that put the value factor on the map, and the popular writers and podcasters who've carried it to the rest of us. Third, I'm going to be honest with you about value's worst recent stretch. The near decade where this whole idea looked broken to a lot of people. Fourth, the backstory, a firm called Dimensional, and why a group of its leaders broke away to start Avantis. Fifth, exactly how Avantis builds a value fund, and what's actually inside it. And finally, we'll set up the backtest. So what is the value factor? Imagine two companies that are, business-wise, nearly identical. Same profits, same industry. But the market is excited about one for whatever reason, and bored by the other. The exciting one trades at a high price relative to its actual earnings and assets. The boring one trades cheap. Now here's the key. If you pay a high price for a stream of profits, your future return on that purchase is lower. If you pay a low price for a similar stream of profits, your future return is higher. That's not magic, it's just arithmetic. The whole idea of value investing grows out of that single observation. The price you pay relative to what the business actually earns matters for what you get back. If you pay $50 for something, and you pay $100 for something else that's equivalent, well, you got the better deal with the $50, didn't you? So when investors say value stocks, here's what they mean. Companies trading at low prices relative to fundamentals, things like earnings, book value, or cash flow. The classic yardstick is price to book. the stock's price divided by the accounting value of the company's assets. A low ratio, and it's a value stock. Unloved, cheap, often in a dull or troubled industry. A high ratio, and it's a growth or glamour stock. The exciting names everyone's optimistic about. The important thing, value isn't about bad companies, it's about cheap prices. And the bet is simple. As a group, buying the cheap basket has historically paid off, even though any single cheap stock can absolutely be cheap for a very good reason. Long before there were spreadsheets and factor models, Benjamin Graham, Warren Buffett's teacher, wrote it down in the 1930s and 40s. His framing was that a stock isn't a flashing ticker, it's a piece of a real business with an intrinsic worth, and your job is to buy it for meaningfully less than that intrinsic worth. He called the gap between price and value the margin of safety. Buy a dollar of business for 50 cents. That's the popular, intuitive route of value investing. And it's why, when you hear the academic version in a minute, it should feel like common sense because it pretty much is. I'll keep the academic part of this as plain and simple as possible. In the early 1990s, two researchers, Eugene Fama and Kenneth French, looked at decades of stock data and asked a simple question. What actually explains the differences in returns? They found that beyond just the overall stock market, two things mattered a lot. One, smaller companies tended to outperform larger ones. Two, and this is our story, cheaper value stocks tended to outperform expensive ones. They packaged this into what's called the three-factor model: market, size, and value. The takeaway that rippled through the whole industry was that the value effect wasn't a fluke or one lucky stock picker. It showed up systemically across decades and across different countries. Fama later won a Nobel Prize for this body of work. The research didn't stop in the 90s. In 2015, Fama and French expanded the model from 3 factors to 5. They added 2 more characteristics that help explain returns. Profitability. More profitable companies have tended to outperform less profitable ones. And investment. Companies that grow their assets conservatively have tended to beat those that expand aggressively. Hold on to those 2, profitability and investment, because they're exactly the extra levers that the firm we're about to discuss, Avantis, leans on. The lesson is that it's not enough to just be cheap. Ideally, you want cheap and profitable and disciplined with capital all at once. At this point, I'd like to raise a fair question. Why would this premium exist at all? There are 2 camps. The risk camp says cheap companies are genuinely riskier. They're often distressed or out of favor, so the higher return is just compensation for bearing that risk. It's like getting paid more to hold something uncomfortable. The behavioral camp says investors are human. We overpay for exciting growth stories and we shun the boring, beaten down names, which pushes the value prices too low and sets them up for better returns later. Honestly, it's probably some of both. And for our purposes, what matters is this. Whether the cause is risk or human nature, the pattern has been remarkably persistent. If you want to go deeper, Google is your friend, and here's the lay of the land. On the academic and quant side of things, the firm AQR and Cliff Asness in particular have published widely. Their paper, Value and Momentum Everywhere, shows these patterns across many markets and asset classes. And fact, fiction, and value investing directly takes on the skeptics. For the educated do-it-yourself investor, Larry Swidrow's books on factor investing are a great readable bridge between the research and an actual portfolio. And if you'd rather listen than read, well, the Rational Reminder podcast and Ben Felix's videos have done more than almost anyone to bring this research to regular investors. I'll point you to these rather than just ask you to take my word for it, because that's the whole spirit of this channel, getting you started and pointing you toward great resources wherever they may be. Now I want to talk about value's so-called lost decade. From roughly 2007 through 2020, value didn't just underperform, it got crushed relative to growth. For well over a decade, the cheap stocks lagged while a handful of giant growth and tech names carried the entire market. People who tilted toward value sat through years of watching the plain index beat them. Articles ran asking flat out, is value dead? Now, the picture I'm showing here is stylized to make the divergence clear. Those aren't exact returns, this is just an artistic representation. But the emotional reality was even worse than a chart can show. This stretch was long enough that plenty of disciplined investors gave up right near the bottom. You genuinely cannot understand value investing without sitting with this period. Winning long term does not mean always winning. There are long stretches where markets can become quite irrational. And to be fair, this goes for any factor, be it growth or momentum too. So, is value dead? The most persuasive rebuttal, argued in detail by AQR, goes like this. The value premium didn't disappear. Value simply got historically extraordinarily cheap relative to growth. And the spread is still really wide right now. The gap in valuations between the cheap stocks and the expensive ones stretched to the extreme. And when that gap is wide, future value returns have tended to be strong, which is roughly what happened in the rebound that followed after 2020. And we're probably not done with that rebound. The honest lesson here isn't value always wins. It's that the premium is real, but it's brutally streaky, just like a lot of premiums, and capturing it requires a long time horizon and the discipline not to bail during the bad years. And that discipline problem is exactly why a rules-based, systematic fund can help. It keeps buying the cheap stuff even when your gut is screaming at you to stop. Okay, so, the Avantis company story. It's genuinely interesting. In 1981, David Booth and Rex Sinquefield founded Dimensional Fund Advisors, or DFA. Their whole pitch was radical for the time. Don't try to pick winners or time the market. Just systematically capture these academic premiums, like size and later value, in low turnover funds. And they went straight to the source. Eugene Fama and Kenneth French, the very researchers behind the factors, were closely involved with the firm as directors and consultants. So DFA basically took research that was sitting in finance department journals and turned it into real investable products. For decades, they were the gold standard for evidence-based, factor-based investing. But there was a catch, and it's a big one. For most of its history, you could not just go out and buy DFA funds. They were sold almost exclusively through a network of approved financial advisors, typically fee-only advisors that you had to hire. If you were a do-it-yourself investor, the door was essentially closed unless you paid someone for access. On top of it, they were structured as traditional mutual funds, often with meaningful minimums on the institutional side. So the strategy was brilliant, but the access was gated, and for a regular investor who'd read all the research and just wanted in, that was genuinely frustrating. Which brings us to 2019. Eduardo Repetto, who had been DFA's chief investment officer and co-CEO for years if I remember correctly, left the firm, and together with another former DFA leader, Patrick Keating, he teamed up with American Century to launch a brand new shop, Avantis Investors. Same intellectual DNA as DFA. Captured the academic premiums systematically, but Avantis fixed the problem of access. Avantis funds are exchange-traded funds or ETFs, so anyone with a brokerage account can buy them, commission-free, no advisor required. The fees are low, with no advisor layer on top at all. and they refined the method using the newer research, including those profitability and investment factors. Now, I'm not here to bash DFA, they pioneered all of this, but it's fair to say Avantis took the same ideas and made them open to everyone, and DFA has since launched its own line of ETFs, partly in response. So, how does Avantis actually decide what to own? The core idea is what they call an expected returns framework, and it's surprisingly intuitive. Think of a company's expected return as a relationship between the price you pay and the profits you're likely to get. Pay a low price relative to a company's expected future cash flows, and your expected return goes up, in part because you put up less money at the front, and so you have to make less to break even and then start gaining. Then favor companies that are actually profitable and that aren't burning capital on aggressive expansion, and this is the key to the strategy. And you tilt the odds further in your favor. Notice what they're not doing. They don't forecast the economy here, and they don't pick hot stocks. They sort the entire market by these characteristics every single day and lead toward the names with the best combination of them. That is, the best combo of low price, high profitability, and disciplined investment. Concretely, Avantis pulls 3 levers, and you'll recognize them straight from the 5-factor model. Lever 1 is valuation. They overweight stocks trading at low prices relative to book value, the cheap end of the market. Lever 2 is profitability. Among those cheap stocks, they favor companies with strong, stable earnings rather than just statistically cheap junk. And lever 3 is investment discipline. They lean toward firms that grow their assets sensibly instead of empire building. Cheap, profitable, and disciplined. That combination is the heart of the Avantis method, and it's exactly what separates it from a plain mechanical value index that only looks at the price. Avantis funds are technically active, but not in the way you're probably thinking. There is no star manager making a bet on NVIDIA. Active here just means daily, flexible implementation. A traditional index fund has to buy and sell on a fixed reconstitution date, which everyone can see coming and trade against. Avantis instead adjusts continuously and patiently, which lets it trade more cheaply, avoid forced moves, and stay tax efficient through the ETF structure's in-kind mechanism. And it holds thousands of names. So it's capturing the factor broadly, not betting on a handful of stocks. The whole goal is to capture the premiums the research identifies, while quietly minimizing the costs and the taxes that eat into real-world returns. It's systematic, just with a smarter steering wheel than a rigid index. Now, let's look at AVGV itself. Avantis sells a whole range of individual value funds: US large cap value, US small cap value, international value, emerging markets value, and so on. We'll dive into some of these funds in later videos. But AVGV bundles them into a single fund. It's what's called a fund of funds. You buy this one ticker, and under the hood, you own a globally diversified all-cap value portfolio that Avantis rebalances for you automatically. It launched in June 2023. Keep that date in mind for the backtest. And it costs roughly 0.25% a year, about 0.26% to be precise, with no extra fee layered on top of the underlying funds. And I think that fee may be going down over time. But anyway, the whole pitch is simplicity. One purchase, and you've got a disciplined global value tilt without juggling 5 or 6 different tickers yourself, and you trust the academic researchers and experts to vary the weight of those constituent funds as needed. Under the hood, AVGV is tilted around 2/3 US and 1/3 international, with a deliberate extra helping of smaller and deeper value companies. Because remember, that's where the historical premiums have been the strongest. I'm keeping these as approximate target weights since Avantis can adjust them over time, but the exact percentages matter less than the overall shape. This is global, it's all cap, and it is tilted to the value factor. But here's the problem for investors who follow the quants like me. This is a very short track record, right? AVGV just launched in June of 2023. A couple of strong years tells you almost nothing about how a strategy actually behaves through a real full cycle. A market crash, a recession, or as we just talked about, a long stretch where value falls completely out of favor. If I just ended the video here and showed you AVGV's line returns since launch, I'd be cherry picking a tiny and frankly flattering sample. To judge a strategy like this one honestly, we need decades of data, not a handful of months. So here's the trick. Because Avantis is built on the same factor research as DFA, and because DFA's value funds have track records reaching all the way back to the 1990s and early 2000s, we can build a stand-in for AVGV out of those older DFA funds, region by region, size by size. US large value maps to a DFA US large value fund, US small value to a DFA small value fund, and so on down the line. Now, I want to be straight with you, this is not a perfect clone of AVGV. Avantis leans harder on those profitability and investment screens, and it trades more flexibly. So think of this as a close proxy for the value exposure, not an exact replica. If theory holds, AVGV should be more successful than these constituent DFA funds because of its additional factor accounting for profitability and investment. But it lets us hit rewind 20 plus years and watch how a globally diversified value tilt would have actually behaved through the good years and the painful ones. Here's the exact recipe we'll run on testful.io. We map each slice of AVGV to its DFA equivalent and assign weights. US large value gets 35%, US small value 17%. A US targeted small and mid value fund 8%, international value 20%, international small value 10%, and emerging markets value 10%. Add it up, and that's a global all cap value portfolio, roughly 60% US, 30% developed international, and 10% emerging markets. We'll rebalance it once a year with 5% absolute drift bands, so it stays close to target without overtrading. Same spirit as AVGV, just with 20 plus years of history behind it instead of a couple of years. So that's the setup. We know what value is, we know the evidence for it, and the honest case against it. We know where Avantis came from and why it exists, and we've built a long-run stand-in for AVGV out of decades-old DFA funds. Now comes the fun part, the actual results. Over the past 20 plus years, what did this global value strategy really deliver? Not just in return, but just as importantly, in risk and volatility, and in those gut-wrenching drawdowns. Let's run the backtest and find out. To start off, we begin with AVGV. We've only got about 2.93 years to work with, but that's okay. We create our backtest approximation. DFGV sim is what I'm calling it. Set it to yearly rebalancing and give it the 5% absolute bands to rebalance if the constituent funds drift too much. And then we go ahead and run the back test on that. And you can see that it's a pretty close match. Now, I will say that it's a little bit below AVGV, but that's not actually bad for a back test. We just really want to have the same general pattern of behavior here. So we look at the correlations and we see we've got a 0.983 correlation between the two funds. So, and that's what we want. And it's not a bad thing that DFGV SIM is actually performing a little bit worse than AVGV. because it's going to give us a conservative estimate of the behavior of a similar strategy in the past. It's way better to undershoot and be pleasantly surprised later than to overshoot and overestimate what a strategy can do. Going back 26 years and investing in February of the year 2000, a very interesting time to invest indeed, we can now compare what our DFGV SIM would have obtained for us compared to the total US stock market and the total world market with a starting investment of $10,000. And you can see that it beat the total US market and the total world market, both in absolute returns at the end of our journey, as well as in risk adjusted returns. You can see that the simulated backtest for AVGV had a Sharpe ratio of about 0.49 compared to the total US market, which had 0.43, and the total world market, which had 0.36. This is pretty amazing performance during a time period when the US stock market and US large caps allegedly dominated. Well, right here we can see that a global value approach actually dominated them. Now, the really cool thing about testful.io is that we can go ahead and save this fund as a portfolio ticker so that we can embed it in other portfolios like the Immortal Portfolio, for example, which I cover in another video, and see how things will behave with this simulated thing embedded in our own portfolio. So we save as a portfolio ticker, and we're going to set it to a daily refresh policy, and then go ahead and click save. And I have already saved this ticker before, but I'm just going to save it again so that you can see this for the sake of demonstration. Now, the truth strength of a global value fund like AVGV is as a component of a portfolio that's been diversified beyond just stocks and bonds. That's in my humble opinion. So, right here, I've got the Immortal Portfolio, one of the variants that I run in my own accounts, um, with the DFGV SIM ticker that we created plugged into it. And you can see for yourself that when compared against the total US market and total world market, this AVGV approximation does even better in the context of the Immortal Portfolio than it does by itself. So the Immortal Portfolio gets up to about $130,000 by the end of this 26-year journey, whereas the AVGV back-tested portfolio alone only got to about $120,000. And you can see that the max drawdown of the Immortal Portfolio is considerably less than AVGV on its own. The volatility is much better, and the Sharpe ratio is 0.79. So it can really pay to take a global value strategy and embed it in the context of a well constructed and diversified portfolio that goes beyond just stocks and bonds. But that's a subject for another video. The point of this one was to dive into AVGV, approximate it with a backtest, and talk just a little bit about how it can work in the context of other portfolios and give you an overview of testful.io and the fun things that you can do with this particular website. I hope you enjoyed this latest offering of Miller Momentum. I always enjoy these ETF and fund deep dives. Don't forget to like and subscribe and leave a comment. I love hearing from you, and I can't wait to see you in the next video. Thank you for watching.